Headline today is market internals point to an extremely bearish setup. However, you have a 4,900 price target on the S&P. You still have earnings at $230. You say valuations are getting increasingly more attractive. Multiples have already adjusted to rising rates. I mean, that doesn't sound like your narrative is extremely bearish. So where's the disconnect?
No, I don't see a big disconnect. You know, when I basically look at the fact that investors are paying an arm and a leg for defensive stocks, that just tells me that positioning is very bearish, and I would be basically looking to the other side. That just tells me that sentiment is very negative, tells me the position is very negative, and people are basically positioned for recession. Our base case is this is not going to be a recession in the next 12 months. That's our house view. And so we think from that angle, the portfolios are wrong-footed.
I mean, I don't want to put you in a difficult spot because, you know, you might see Jamie in the cafeteria from time to time, and he may wander by your office and vice versa. But what do you make of he sounds like somebody who would not have a 4,900 price target on the S&P, nor that earnings were going to hold up to the degree at which you do, nor that he thinks valuations are all of that attractive now, and that maybe we've adjusted to rising rates, because he talks about one of the principal reasons for his worry is Fed tightening and never having had QT like this, quote, end quote.
Yeah, so I think Jamie says, right, there's a storm coming. We don't know if it's a mild storm or if it's a severe storm. I think the market is already discounting and pricing in something more than a mild storm, and we don't think it's a severe storm. So again, 4,900, that's our year-end price target. Between now and then, that's 7 months. A lot can happen. We need to see what happens on inflation side. We need to see if Fed goes restrictive or if they pause somewhere around neutral rates, in which case positioning being so bearish, I think you're set up for a potential reversal.
Why? That's what I'm trying to get my arms around. Why? When everything seems to suggest, as Steve Weiss said as well, we're in a very difficult environment. And the unknowns, I would make an argument, skew to the negative rather than the positives. I mean, could there be an unknown positive coming out of the war in Ukraine? Sure. But the other unknowns skew negative, don't they?
No, I would actually argue the opposite way. I think that a lot of the unknowns, most of the unknowns are there. I think the backdrop has basically gotten hit from all sides, from basically just about every angle. And so I think the big unknowns here is really, do we have some form of, I don't know, further escalation on the Ukraine side, where, I don't know, Russia decides to, completely put a halt on natural gas, and then Europe goes into recession. That's an unknown. That's a tail risk. It's not our base case. Another unknown could be, could we see more hedge funds going basically belly up that were riding the tech wave? That's an unknown, but I think it's very hard to put a base case on those. So we generally, when we look at the economy and when we sort of look at the current backdrop, are we going into a slowdown? Yes. Are certain parts of the economy on the good side going to go into recession? Yes. Arithmetically, they have to. But I think the broader backdrop, to me, doesn't suggest a full-fledged recession. It suggests at most a technical recession. And I think the market is pricing in a pretty heavy dose of negatives already. And so that's why I would almost be asking the other side of the question.
Okay, that's fair. You also see this is going to be a point of contention, too, for some. You see a cyclical growth bounce. So you think that let's just talk growth, like tech. You think tech stocks have re-rated, if you want to use that terminology, enough?
So you mean derated, I imagine, right?
Yes. But I mean, they have re-rated, too, lower.
Okay, yes. So, look, I think there's a little bit of a confusion here when you sort of look at the street sentiment. Everybody just goes immediately to assuming recession. And to me, this is less about recession. This is more of what I call equity duration cleansing. We basically entered this historic rate pivot. We just simply an S&P 500 index that had too much duration bias, long duration bias. And so we've been generally arguing for rotation from long duration to short duration assets. On the short duration, for instance, you have energy. And I think we're pretty far along that process. And so I think the index sensitivity to rates, I think, will be diminishing because there's been already a pretty substantial adjustment done on the long duration side. So the market has gone to basically pricing in from early cycle, immediately late cycle playbook. And in my opinion, anything short of a recession, late cycle playbook is just wrong. So I think we need to be open-minded about the fact that we go back to mid-cycle. Mid-cycle, you basically see both cyclicals, traditional cyclicals, as well as tech bounce before eventually you go back into some form of defensive growth trade. So
Okay.
that's where I just think the market has basically ran ahead too fast.
It's definitely run ahead. Whether it's too fast or not, it's going to be interesting to watch. Joe, you have a question for Dubravko?
I certainly do, Dubravko. Good to see you. So I think you're talking about a very large sector rotation within the equity market where a lot of the current leaders should be sold off and should be going out and buying the laggards. Can we be doing that now without knowing whether or not inflation is going to be arrested? Do you have any confidence that inflation will be arrested to make that rotational trade?
So again, rotation for us is from long duration to short duration, so from tech to energy. I think if inflation stays at an elevated level, I think the energy, the commodity trades, I think they actually continue to do just fine. And again, our base case is this is not a recession and we're not going to have significant demand destruction. So we think that that side of the equation, I think, holds. Tech, on the other hand, has derated quite a lot. And so I think sensitivity now of these long duration equities like tech to rates, I just think it's lower. And so that's why here I think you need to see inflation accelerate even further from the current levels, and you need to see rates go a lot higher, I think, for there to be a lot more carnage. So that's why I think the question is where are sort of expectations and sort of how much further do you go from the current level? And I think a lot is already in the price. I think a lot is in the expectation. And there's been already a pretty substantial adjustment. And that's why sort of when you look at defensive versus cyclical, the multiple spread between defensive stocks and cyclical stocks, it's at 98th percentile. Why would you want to be in defensive stocks? I mean, even if you go into recession, the last stocks that are holding up tend to roll over. And if you're not going in recession, which is our base case, back to mid-cycle playbook, defensive, I think, is going to be used as a source of funding for other parts of the market.
Well,
and so I just think the positioning is too skewed to the negative side.
Lastly, I mean, it's interesting you say that, and to play off of that, I saw a downgrade today of utilities to underweight at Jefferies, and I thought of that line in your note where you talk about defensive stocks having valuation risk. But in terms of rotation, I mean, there are some who say, and I know you like energy, as you just said, as the best risk reward, but there are some who say, you know, that's the last group that's yet to be hit hard, and that eventually they're going to come after that, and that, you know, that's just, it's going to happen. It's just a matter of when. You don't think so?
Oh, so could there be some tactical profit taking? Absolutely. But I'll say a few things. We as a house estimate that by 2030, you need about $1.2, $1.3 trillion in oil and gas capex for oil and gas demand and supply to balance out. On the supply side, nothing is being done. Nothing. Valuation-wise, the sector hasn't gone up. The entire move up in energy has been in lockstep with earnings. Multiple is a 9.5. So could there be some profit taking? Possibly, absolutely. But I think the sector remains in a very good spot. And so I would be buying on pullbacks, especially for the energy complex.
Great to see you again. Better yet, it's great to get your perspective and your point of view, Dubravko. We'll see you soon.
Thanks for having me.
Yeah, that's Dubravko Lakos over at JPM.